This operations strategy is about inventory management. It details a number of inventory management systems and mostly the costing of them. So inventory or stock refers to the amount of raw materials or work in progress or finished goods that a business has on hand at any time, and it's a really important part of operations management that they do manage their inventory and how they cost it is also important. To be able to calculate the cost of goods sold, managers must know the value of the stock which has been sold, and they also need to know what's left unsold, so for their records and accounts for the next accounting period. And there are a number of different methods to use, and all of them, of course, have their own advantages and disadvantages, and all the methods are based on assumptions. So this costing of inventory is an accounting function. Even though it's here in operations, it's an accounting function, and you really just need to pay attention. LIFO and FIFO explained. These are simply ways to account for the costs of inventory. Okay, so it's just accounting methods, and it's accounting for inventory that's been sold and inventory that remains unsold. Remember, it's an asset on the balance sheet. It needs to be counted, it needs to be accounted for, and it is important that businesses know how much inventory has been sold and at what cost to them. And they also need to know what is the cost of the inventory that they still have sitting in their warehouse or on their shop floor. So LIFO is the first one, and as the name says, it's last in, first out. So it assumes that the last goods that you purchase to sell are also the first goods that you actually sold. Okay, so that's LIFO. Therefore, the cost of each unit sold is the last cost recorded. FIFO, which is the other one, just here, it assumes first in, first out. So it assumes that the first goods you purchase, and that could have been back 6 months ago, are the first goods that are sold, and therefore the cost of each unit sold is the first cost recorded. Look, don't worry too much if this is sounding a little bit confusing to you now. Just read over it again in the book. But I really would like you to have a go at answering this question. So once you've got your head around it, I want you to think about this question. Which method, LIFO or FIFO, would result in a lower cost of goods sold? And then what effect would that have on gross profit? Okay, there's some questions here that I'd like you to have a go at answering, so it'll help you to understand why managing inventory or managing stock is so important. So have a go at those three. I have no idea why those numbers came out 1, 1 and 1. It should have been 1, 2 and 3, obviously. But write those down in your book, please, and when you come into class, you need to have thought about answers. Okay, on this slide here you can see it's the advantages of holding stock. And as it says at the top, the issue that's of importance to all businesses is exactly how much to carry. There's issues with carrying too much and there's issues with carrying too little. So some of the advantages are that consumer demand can be met better when stock is available. Of course, you think about yourself if you've been frustrated by something not being available when you want it. If a particular product line runs out, well, you can find an alternative for the customer. Well, we haven't got that one in, but we've got this one. And who knows, they may actually take you up on the offer. It reduces the lead time between order and delivery, which some people get frustrated with. Stocks also give the opportunity for a business to generate immediate sales. They may just buy from you simply because you do have it in stock rather than waiting for someone else to get it in. Stock can be dispatched to distribution centres and they can then quickly transport them to places as required. Just think of Bunnings. Think about the amount of goods that's transported to Bunnings stores all around the country. Older stock can be sold at reduced prices and it will generate cash for you. And stocks are an asset and they're of value to the business. So it looks good on the balance sheet, of course, to have stock. Making products in bulk can reduce costs as there are economies of scale in buying inputs, and ordering in bulk can mean you get volume discounts. But of course, for every upside, there is also a downside. Okay, so here, of course, we're looking now at the disadvantages of holding stock. So there is a current trend amongst businesses to hold as little stock as possible, and mostly it's to do with costs. So the costs in holding stock can be as high as 30% of the value of stock. There's all sorts of things to consider too, such as just the cost, the physical cost of the storage. Could spoil, could go off if it's perishable. There's insurance to pay, sometimes there's theft, there's handling expenses, and you often have to have security as well. There is invested the capital, labour and energy. You can't use it anywhere else. It's already been used to create stock. And a big one for a disadvantage of stock is obsolescence. If you're holding things in stock, and gets to a point where nobody wants them anymore, well, you're going to have to just get rid of them and possibly not get anything for them. So an example there is the Walkman became obsolete, of course, as soon as the iPod came out. And CDs are going the same way as becoming obsolete because something else comes along and replaces it. A very popular way of holding stock is called just in time, and it's very, very popular. Dell uses this method of holding stock. JIT, which is what it's called for short, aims to have the business only make enough products to meet demand. So this approach that allows retailers to display a wider range of products as they need to store less and can order in response to consumer demand. JB Hi-Fi also do this. It saves them money, there's no expensive holding and insurance costs, there's no shrinkage costs, and then losses due to obsolescence, so that's an advantage. However, if you're going to employ this approach, you need to be very flexible and have high turnover and flexible processing. I'll just write in here JB Hi-Fi so that we remember. It's a good example to use. JB Hi-Fi. Sorry, it's in yellow. Another way of costing inventory is the weighted average cost, WAC for short. It is obviously a very simple way of costing your inventory, where you just take the average price of everything you've bought. Because if you're buying stock over a period of time, say it's 6 months or 12 months, the price that you paid for that stock, of course, is going to change over time. So this method just looks at averaging out, looking at how much you paid across the board and then averaging out how much that was. It's a very simplistic method, and some people think it is too simplistic. We're going to be looking soon at LIFO and FIFO, and we'll explain those in a bit more detail. There's some revision questions here that you need to do before you come into class. So revision questions 1 to 5 and 7, 8 and 9, and they're all on page 101.